Hi, everyone, and welcome back to another segment of Mish's Market Minute. I am your host, Mish Schneider, and today we have a brand new agenda, which I hope you'll really enjoy, find it educational, and always like to leave you with actionable information. It's going to be on market phases. What are they? Why do I use them? When do they change? And how they make really good trades. I'm going to talk a little bit about how to trade the phases and how you manage your risk. And then I'm going to leave you with a few instruments that are changing phases with an action plan for you to look at. So let's get started and begin with what are phases. Now, there are 6. Most people know about the bullish and the bearish phase, but I like these in-between phases because they give you a tremendous amount of opportunity to trade the market no matter what's going on. And so you can lose the bias that I only trade in a bull market or I only trade in a bear market and really go for these in-between phases. And I just want to say quickly that I've also written a book about phases called Plant Your Money Tree, and I encourage you, if you want more information that really goes into it, starting with 2008 and how to use them, to buy the book available on our site, Money with Mish or Market Gauge. Now, with that said, the top phase, of course, is the bullish phase, and that I always like to associate each phase with an emotion, given the fact that the markets are very behavioral. So of course, when we're in a bullish phase, we're in this state of euphoria. But of course, euphoria cannot last. Human nature, always we're waiting for that shoe to drop. And that's when the market goes into a caution phase and people start to get a little bit anxious. And then if things go from bad to worse, then we go into a fearful place or a distribution phase where literally money is being distributed out of equities into cash or some other safety type instrument. And then of course, if things go even worse from there, we go into a bearish phase, which often is a period of despair. And we've had a great example of this just in the few months of 2020, starting out in this euphoric phase when the Qs and the SPYs made new highs, and then up until the end of March or in the middle of March, going into, oh my God, this pandemic has closed the economy, and now is a despair, and the economy is never going to get better again. But of course, what makes human nature and the markets, and of course, a lot of stimulation by the Fed and the governments, is when we come into a hopeful place, and that is called a recuperation phase. And then, of course, if things start to really show that it's not just based on hopefulness, but real optimism, then just the opposite of a distribution phase is an accumulation phase where money comes back and accumulates into equities and goes out of cash. People are more optimistic. And then, of course, we go back into a bullish phase. Now, it would be so nice if I could tell you that this always works in this beautiful clockwise fashion. But really, the reality of the situation is that phases change a lot. So we can go from bullish to caution, back to bullish, back to caution. The information that I usually get from that is when you start to see rapid phase changes, is that something bigger is coming. So now, how do I determine the phase? Well, essentially, I use something that I've been showing you now every week, which is 2 simple moving averages, the 50 and the 200-day moving average. In the book, in Plant Your Money Tree, I use weekly moving averages, and I actually like to use a combination of both for my trading because one is nearer term and one, of course, gives you a little bit of a step back. So not only am I looking at those two moving phases, boy, that's a slippery mouse there, sorry about that. But I'm also looking at a couple of things. One is, where is the 50 relative to the 200? So is the 50 above, below, or crossing the 200? Then I look at the slope of the moving averages. Is the slope moving up, or is the slope neutral or moving down? And the reason why is simple physics. This really has a lot to do with momentum. If a conductor is pulling a train of 50 cars, then obviously those 50 cars are going to move a lot faster than 200 cars. So the 200 cars being slower to change in slope also gives us information. But if a phase changes and the slope is actually in opposite direction of the phase, then we can adjust what our plan is for trading accordingly. And then finally, we look at where the price is relative to both of the moving averages. In a situation where we're looking at a bullish phase, for example, we want the 50 to be above the 200. We want the slopes on both to be positive, and we want the price to be as close to the 50-day moving average as possible, because if the price is all the way up here, then pretty much what that tells you is that this could have a big correction back down to the moving average, and now you've lost all this money during that correction. So essentially, I'm also going to show you how you can use a retracement to the phase change as an opportunity for a trade. So let's go through. I like to combine everything with the macro picture. So I give you a lesson, and at the same time, it's a consistency with how I look at the market based on also what we talked about more recently, which has been the channels. And if you recall, I showed you a really beautiful wedge in the IWM, the Russell 2000, which also happens to be the granddaddy of my modern family. So now if we're looking right here, this is in a weak recuperation phase. So here's your 50-day moving average. Here is your 200-day moving average. Look at the slope on the 50 is still negative, but you can see that IWM is actually holding above the 50. So that's why I call it a weak recuperation phase. I also, and I'm going to make this obviously not so neat, but I showed you how we had this sort of channel line here, and right now we're holding above it. So if for some reason it sells off by the end of Friday's session and closes under 124.50, that weak recuperation phase shows you that really buying here in the middle of this range between, say, 136 and 125 is probably going to be a chop fest. Now the next one to show you in terms of the phases is the NASDAQ. Now NASDAQ is a completely different picture, because NASDAQ is not in a bullish phase, by the way. In this case, what we have is the 50 under the 200, but the price above both, and that means this is what we call an accumulation phase. So we've seen the accumulation of money into the FANG stocks, and it's reflected here, and that's why this is doing so well. In terms of the strength of this phase, it was weaker, but look what's happened here now to the slope of the 50-day moving average. It's neutralizing and it's slightly pointing up. If the price stays up here, even if the price goes sideways for a while, what you could potentially see is this 50 cross over the 200, and guess what? Then we would be back in a bullish phase. Our price would be far from it. So I wouldn't necessarily say it's a great trade based on a phase change, but it would be good information. Now, the other interesting thing, which has nothing to do with phases, just good old-fashioned chart reading, which you know I love, is that if you look at this resistance here, right before we had the crash, we're heading right into it, darn close to it right now. So again, we watch IWM to see whether or not it can hold above the weekly wedge and start going through, let's say, 130 and keep that recuperation phase intact, or whether or not that starts to sell off or this sells off, therefore weakening the whole market. Now the next phase here is part of my modern family, and this is biotech. And last week I showed you a beautiful weekly channel that told you that if it broke out of that channel, which went back from 2015, that would be a good buy opportunity, and that this particular segment in the modern family, by the way, is very hot right now in a bullish phase. You can see that right here. The 50-day moving average and the 200-day moving average is pointing up. The price is well above it. This actually peaked in price in 2015 at around 133, excuse me. And now if we get a close above the channel, which you can't see here on the daily, above 128, essentially that would be an opportunity to not only buy. Obviously you wouldn't be able to risk down here. It would be a very different type of trade, but essentially what it would tell you is that there's a really good chance that this would continue to make new highs. Now in the next chart that we have here, this is the other part of the modern family, which looks completely different than what I just showed you in biotech or semiconductors, which would be kind of similar to what you're seeing in Qs. I don't have a chart of it here, but it's tech, and that's also in an accumulation phase very similarly. This one is now back in a bearish phase, and it's a strong bearish phase. When we had the death cross right here, that was the start of the bearish phase. Of course, the price was well under it. And I'll talk about these other phases momentarily. But essentially what you want to see with transportation, which represents the demand side, and of course the big Buffett story about selling airlines, etc. But even forgetting about all that, regardless of the optimism that we're seeing in other areas of the modern family, particularly in the NASDAQ and in the semiconductors and biotech, we're certainly not seeing any anticipation yet, other than the fact that it has rallied from the low in March, that demand is really going to pick up any time soon. So with this, of course, we'd be looking to see if this can get back over and hold above that 50-day moving average. And then two very similar, before I get to that, this is VIX. And I thought this was an important one to show you as well as part of the whole market breadth. What we see here is that it broke the 50-day moving average. This is called a caution phase, what I showed you before. So when the euphoria, in this case the fear, starts to abate, and now it goes into a caution phase. This is good for the market, but it's a weak caution phase because look at the slope of that 50-day moving average pointing up. So again, this is another thing we have to watch to see if it holds the low that we had last week of around 35, 36. And if it gets back up above and confirms above the 50-day moving average, then we know that fear has returned to the market. So you can see everything I've shown you is very mixed so far. Now here is retail, also part of my modern family. This is granny retail, brick and mortar retail, even with news of Neiman Marcus, JCPenney, etc., dealing with bankruptcy issues. This is actually also in a recuperation phase, and maybe the slope has stopped going down in the 50. It's a little too soon to tell. But reason why I wanted to show you this is because I wanted to give you an example of a distribution phase, which, by the way, I couldn't find anything currently in the modern family in a distribution phase. But here's the power of the phases. When everything was chugging along back in February, and this was above the 50-day moving average in its bullish phase, this first gap down, before anything else really besides one other instrument, which I'm about to show you, went into a caution phase, and look what happened on that slope. It started to decline. This is a distribution phase when the 50 is still above the 200 and the price breaks below the 200. So even if you were slow to the party here, this day was really the day that told you at the end of February that things were rotten in Denmark and it was time to liquidate your long positions and possibly get short. Certainly look at VIX. And of course, you can see the incredibly dramatic decline that we had in a short period of time. So now here we are. Basically, what we're saying in XRT is there is some hope, but hope has certainly not turned into optimism. That wouldn't be unless this got back over the 200-day moving average up at 40. And quickly, I just want to show you KRE because it's a similar situation. This is the regional banks. This is still like IYT in a bearish phase. It's still under the 50-day moving average. So certainly this is negative based on not only the oil market this is very much tied to, but also just the consumer weakness in the banking system. And here you go. We're not seeing any great hope here right now. If you think this is in a difficult environment to really sink your teeth into, you're absolutely right, and these phases reflect that perfectly. And by the way, this boxed area here also is the same situation. First to go into a caution phase and then break into that distribution phase, giving you a big heads up. I'm a firm believer of phases. Okay, so now let's go on to how to trade the phases and manage risk. Now, what I want to do here is I want to do this with the other indicators that I have been showing you, ones that have been plugged into the StockCharts platform, and that's market gauges, real motion, and triple play or price performance and volume performance indicators. This is FXE. So essentially, I'm showing you this one because I showed you this one last week saying that when it was breaking the 50-day moving average at the same time that the real motion was clearing the 200 and the 50-day moving average, at the same time it wasn't necessarily outperforming our major benchmark here, but it was improving. But what did I tell you? I told you, and this is with all phases, you need 2 days to confirm. You needed the second day for this to close over the 50 before you would go ahead and get long. So if you heard that, you didn't trade this, or you certainly didn't buy it. If anything, you could have shorted it by buying the dollar. And now here it is back into the support level. I still keep my eyes on this though, because you can see that it did not break down under the Bollinger Band on this recent crash. The momentum is starting to improve a little bit. If we see any kind of divergence again, like this clears the moving averages on the real motion, even before it clears the moving average on the actual chart, that might be interesting information about the dollar as well. This one is Beyond. Now, Beyond is a classic example of a confirmed phase change yesterday, or actually Wednesday when it reported earnings, or Tuesday when it reported earnings actually. It had a gap up and then bam, it rallied. This is your 200-day moving average. So this is a classic accumulation phase that confirmed today. The day, of course, yesterday had a huge volume spike. This one not so great. But what's interesting to me here is, what can we say about Beyond? What we can say about it right now is that there's no divergence. The momentum came off a little bit, the price came off a little bit, and the relative performance as a leader against the benchmark also came off a little bit, but still in strong leadership. So in something like this, when you have this confirmed phase change, what you want to see now is what type of level consolidation. And in terms of risk, this is very easy. All you would need to do is risk under the 200-day moving average, or around 110, and let's say it cleared the highs that we had, which was at about 124, 125, essentially with a $15 risk and a range of about $10 a day on this. You would want to see if this could actually give you $30 from 125 or 155. Is that impossible? No. Look at the last time 155 is. But I also would caution you to make sure that the momentum is staying in line with the price. This is Zoom. Now I'm showing you Zoom because this is the example of buying when it retraces to the 50-day moving average. And also I like to show you things that my members have, so that we all have skin in the game. And in this one right here, every time this, well, first of all, you can see back in time when this broke out of the 50. At the same time, this was also breaking out with the price performance, and momentum was starting to increase, but we didn't have a lot of information. Don't forget, this is a relatively newer instrument here, a publicly traded instrument. We got long, we kind of missed this one right here. So we got long on this retracement here to the 50-day moving average, because what it does is you can risk now to, if it breaks the 50, you're gone. So let me just show you what else I had to see at that point. Number one is I wanted to see it hold the 50. Number two is I wanted to see what happened here, and that's not clean, but I wanted to see what happened here with momentum, with price performance, and it was starting to show that it wasn't going to break the Bollinger Band, and it was clearing back over that shorter term moving average. And then in real motion, even though the price hadn't broken the 50-day, this actually did, and then came right back. So we didn't buy it on this day. We wanted to see that real motion confirm, and we actually bought it at 145. Now, interestingly, if we go to today, I took some profit, not full profit, just partial profit on the position. Why? Three reasons. One is, going back to real motion, we're now running into the resistance at the Bollinger Band. Going into the price performance, we're running into some resistance here at the Bollinger Band. And going into price, just good old chart reading, we're also running into resistance there. But it's a classic example of buying a retracement. Now, let's talk about some real actionable trades for you to look at going forward. So the first one is silver. I also know that I featured silver. I've been featuring silver to you as long as I've been doing these stock chart segments, because I have a theory, number one, that silver will play some serious catch up. Two, that even though the indicators are pointing to a deflationary environment now, the fact that prices are rising, demand still being slow, once that demand comes back, we actually could be looking at more of that stagflation. And if those of you want to look at that and haven't looked at it, that's a video that you'll find in the stock charts from April 17th. But I showed it last week too, because I was also interested in the fact that I was starting to see some movement in real motion. And now here we are. Finally, and I said that I probably would wait conservatively for a phase change, it's breaking out over the 50-day moving average today. It did it on very high volume. You can see that big spike in volume. It also held the 10-day moving average. If we move down here, it's also very much in line in real motion, which broke over the 50-day moving average. And also, if you look at the price, here it's starting to show some signs of leadership against the SPY benchmark here. So if this confirms on Friday, then basically what you would look at is to be a buyer. The risk is very clear. You could risk to under today's low. If you're risking to under today's low and you paid, let's say, $14.40 or $14.50, depending on where it comes in tomorrow, then you essentially are saying, I'm risking about 50 cents. If I want to make 2 to 1, 3 to 1, can I make $1 or can I make $1.50? Well, by the time you get to the next big resistance at the 200, that certainly is very viable. Of course, you'd want to keep your eye on the momentum as well to make sure that it's staying above that 50-day moving average. So that's trade number one. Trade number two, more dicey, and I'm going to show you why. Because what's so great about these phase changes is you can just buy them off the pure phase changes, and that's perfectly okay. But the whole reason why we're putting in and plugging in these real motion and triple play indicators is so that you can get even a better or stronger confirmation. Not only is it a good time for you to possibly buy the phase change, but should you go all in or should you just do partial position? So in TAN, which is the ETF for solar, and by the way, I usually wind up showing only the things that I really like, especially if they're in a mega trend that I particularly like, as this is. Look what happened here. We had a phase change to accumulation that confirmed as of Thursday. Here's your 200-day moving average at 30.22. This is showing some leadership in terms of the price performance, and that's a good thing. So that's okay. We go down here. This is showing, yes, it's gaining in momentum, but here's your 200-day moving average right here in momentum. So while the price has cleared the 200, momentum has not. So would I necessarily be a buyer of this? Well, if the market is strong as a favorite sector and a phase change, maybe I would. Would I go in full guns? Probably not, only because I would be a little bit concerned that even though it showed some price leadership, and you can see it's cleared this last time it reached this peak high here. We're actually above that peak high right now. So based on the price performance, I'd say, yeah, partial. Based on the real motion, maybe I'd be a little bit more cautious, instead maybe set, say, a half a position. In terms of risk, when I do have a confirmed phase change, generally what I'll use as my risk is, with a little bit of fudge, whatever the low is of the day that it actually changed the phase. So it would be the low under this day, which I think was just under 30 at about 29.97, something like that. So if I had to pay 31 and I'm risking about $1, I also have to be convinced that I can get 2 to 1 or 3 to 1 before I start looking at a profit target, or at least going to a no loss stop, which means that I would have to think that this could go to 32, 33, and certainly it could still do that. We could make some money off of it, and it wouldn't even have to fill the gap before we took some profit. The next one I'm going to show you is Disney. Disney is also in a mega trend in that streaming video is a mega trend. Long before we saw the pandemic, I was talking about this, where regular TV and cable TV and premium channels was really going more the way of streaming services. And of course, that's a trend that's intact, and of course has gotten a bit of a surge during the pandemic with Netflix, but not so much in Disney. And in fact, it reported earnings this week and didn't do so well. However, it did today, it had been there before, but it did today break out over the 50-day moving average. So let's take a look and see what happened. The earnings day, big spike in volume. The day that it broke the phase change, unconfirmed, volume not so great. In terms of resistance, we've got a resistance here, it looks like around 105.20 or so. 3 times we've made a high and we haven't been able to clear it. Now let's go down here. Price performance, not showing any kind of leadership. Last time it had that spike high up here, it actually also showed some leadership here in terms of its performance against the SPY. Now it's still underperforming. If we go down here though, again, what's interesting about Disney, and the reason why I'm even showing it to you, is that when this was under the 50-day moving average, look at the real motion, never broke the 50-day moving average. So the momentum was outperforming the price. So now that we're in line where it's over the 50 and this is holding over the 50, if this confirmed tomorrow, which means it would have to trade over 102.91, and the slope is still down a little bit, so it's weak. Again, position sizing would probably prevent me from full guns. But if this broke out over, let's say, around 105.25, where would I risk? Again, it would probably be under today's low as a relatively tight risk. So let's figure we would have about a $3.5 risk to see if we can actually get about $7 or about 112, which is right in line with where it was on that last place. So you can see all the analysis that goes into my mind on a phase change, how strong it is. I like to buy when the price is as close to the moving averages as possible to control my risk. I use a risk underneath the low of the day it actually made the phase change, even the day. I use a second day for confirmation, and then I look to see if there's any kind of divergence on the real motion and the triple play indicators. I've got one more to show you. Certainly, again, no stranger to this, as I've shown this to you a couple of times, and this is DBA. I keep coming back to this, A, because of my stagflation theory, but also because this is intriguing me on the charts, and let me explain to you why. Now, this is, again, in anticipation, because you can see here that this has not broken out on price over that 50-day moving average. So let's see, here we go. So now you can see that this is the 50-day moving average. It looks like it's coming in at around 1406, and we still have a pretty sharp slope on that. But let's go down here to real motion. What do you see here? Two things. Last week I showed you was when it made a new price low here, it did not make a new low from this low in real motion. So it was already showing you that momentum was holding up, although price wasn't. We have another divergence today, excuse me, in that what we're seeing here is the price is under the 50, but real motion is taking out the 50-day moving average. So this is showing momentum is improving even though price is still struggling to catch up. Furthermore, if we go over here, again, it could be starting to show some leadership over the SPY. So if my stagflation theory is correct, that means we've got a really good opportunity to buy silver and to buy DBA. Now, you could be conservative and wait for a confirmed phase change, or you can say, gee, based on the momentum indicators, maybe I'll take a little taste of a position here, and then add over that 50-day moving average, especially since you can see there's some chart points here. Resistance comes in around 1410, and you can get in on a confirmed phase change there, assuming that the real motion indicators are correct. So two choices: get in now for a taste based on the divergence, or wait for a bona fide confirmed phase change and get in then and see if we don't have a nice trend in these very beaten up agricultural and metal ETFs like silver that has well underperformed both the miners and the gold. Okay, that's it for now. You guys have a really wonderful weekend. Thank you so much for watching. I'll be back with you all next week, and bye for now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.